Hello friends. Today we have one of the most important topics in trading psychology. Have you ever wondered why, under seemingly identical conditions, one trader consistently makes a profit month after month, while another with an exact same strategy blows deposit after deposit? What's the secret here? An expensive course bought for crazy money, or perhaps some special intuition granted from the above? As practice and years of experience show, the answer lives much closer than it seems, right in our heads. Today, we will dive into perhaps the deepest and most unexplored universe, the universe of our own psychology. It is very important because it stands almost on par with analysis and becomes the boundary that separates the dream of financial freedom from the harsh reality of losing trades. You know, there's a paradox in trading that for some reason rarely talked about seriously. Everyone comes to the market for money, but in reality, the real battle isn't for money at all. It happens within us, against our own demons: fear, greed, impatience, and pride. And the main question isn't which strategy to choose, but do I have enough inner strength and discipline to follow it? Let's go through the most insidious psychological traps our own mind sets for us. First, we are ruled by greed. We see a rising chart, success stories, and we think, here it is, the chance. We enter a trade at a very peak. Succumbing to the fear of missing out, we ignore all the rules because, look, it's rising. And then the market reverses. And then fear takes over. We watch as profit melts before our eyes, turning into a loss. But we can't close the trade because our brain refuses to lock in the loss. What if it's a bounce? What if it all comes back now? We hold on to losing assets, hoping for a miracle, and in the end, we lose even more. And when patience snaps, we panic and close everything at the very bottom, giving an opportunity to those who think cool. And you know what's most interesting? After this, the market does indeed reverse in the right direction. But we're not there anymore. Emotions kicked us out. And this gives birth to a new, even more destructive emotion: revenge against the market. The desire to immediately win back. We increase the volume of trade without a plan, just to get ours back. And this is the fastest path to a zero balance. Our brain is wired to look for simple patterns. We look at the success story of some guru and think, there, if I do the same, I'll succeed too. But we don't see the thousands who did not succeed. We believe in fairy tales because they are pleasant. But the reality is that the market is not a story about quick money. It's a story about daily routine, work on yourself, about risk management, about cold calculations, and nerves of steel. So what do? How to break this vicious circle? First, awareness. Before starting, ask yourself, am I doing this according to the plan or under the influence of emotion? Am I being greedy right now? Am I afraid? A simple pause of a few seconds can save you money. Second, flawless risk management. Determine in advance how you are willing to lose on one trade. Usually it's 1 to 2% of the deposit. And never break this rule. When you know your maximum loss is strictly limited, fear recedes. You stop being afraid of the market because you have a clear plan for the worst case scenario. And third, keep a trading journal. Record not only entry and exit prices, but also your thoughts, feelings, emotions at the moment of the trade. What you felt before, during, and after Rereading this journal a month later, you will discover a huge number of recurring mistakes. Remember, the market reflects all our internal states, our greed, our fear, our insecurity, and profit goes not to the one who guessed the trend direction, but to the one who first managed to defeat the chaos within themselves. A trader's path is not a path to wealth and easy money. It's a road to self-discipline. And the money is just a bonus for that enormous inner work you have just done. Friends, to make it easier for you to understand how theory works in practice, I suggest conducting a few small trades and seeing how I manage my emotions during trading. We start the search for the first trade. It's on the CHF JPY OTC asset. On the chart, according to the RSI indicator, we see a decline to around 30. Additional information is the fact that the price is resting on a support level from which bounces have occurred before. Psychologically, such moments are the most difficult. Traders often see drop and are afraid to go along, because it seems the decline might continue. But it's precisely here that it's important to trust your plan and analysis. We open the long trade for $10, and indeed the bounce is confirmed. Trade closes positively, we remain calm and look for the next opportunity. Next, we find an interesting situation on USD SGD OTC asset. Here the chart shows a prolonged decline. According to RSI, the price has already reached the 30 zone, but there is room for movement towards the 200 EMI. In such cases, the psychology of risk kicks in. A trader wants to wait for the perfect point, but the market often doesn't grant such luxury. We decide to go long now, considering that the price is already quite low, and indeed the movement reaches 200 EMA. Since the price has hit a strong average, a new pullback is possible. Therefore, we open another long. Therefore, we open another long trade without even waiting for the previous one to close. Both positions close positively. This is a good example of how discipline and consistency help manage emotions in the moment. Asset AUD USD. The RSI indicator is approaching the 70 level. Simultaneously, the chart makes a sharp spike upward. Such a surge often indicates a pullback down. In such a case, it's important to be ready for reversal. We open the short trade for $10. The scenario plays out and the trade ends in a profit. And the last trade, USD EGP OTC asset. On the chart, we notice that the price has consolidated below 20 EMA line. For a trade, this is a signal that downward movement may continue. At such movements, it's especially important not to rush, not to doubt. We open a short trade, and indeed the movement develops further downwards. The trade closes positively. These examples show that indicators provide good guidance, but key role is played by the trader's psychology. The ability to remain calm, act according to plan, not to succumb to excitement, and not fear pullbacks. This is the foundation of a successful approach. Friends, if you found this video interesting and useful, then for you, I have created a community in a Telegram channel. In it, you will receive educational materials, advice, and the most effective trading techniques daily. There, you can ask me any question you like, and You will always get a clear, understandable answer to them. And most importantly, don't be shy. Even the seemingly dumbest questions won't bother me. Together with me, in just a few days, you'll be able to figure everything out and achieve your first results. The coolest opportunity you can use right now is to join my community. Join via the link down below in the description or the pinned comment.